Because you've already broken out of the base, where you can say, okay, measured against broad stock market metrics, gold is now freshly emerged into an outperform candidate. And when you break out of some base that's 11 years wide, it's this clear, you're not just going up for a few months. The relative performance is going to smoke for a couple of years, could be. It won't just involve gold doing better than the S&P. We argue it's going to involve both gold going up and the stock markets going down. What would cause that is not just a thought process, but pain, because that's what drives people to reject old prevailing ideas and go to some new idea. In this case, a resurrected idea that's already been there before for 3,000 years. Gold's been money, in a lot of places, including here, until Roosevelt and then Nixon got rid of that. So yeah, I think we're headed there. And I think one of the factors that will help spark that sense of 52 card pickup, panic, is when you break the stock market. And I think it is in a topping process and has been since late last year. The S&P made a new high by 10% so far this year, above the early year highs. But many indexes and sectors did not. But anyway, I think we're topping in the stock market. When that breaks, that creates a movement of money out of a bursting asset into what is perceived to be, that's a better place to be. T-bonds aren't the alternative this time. In 2000 to 2002, and from 2007 to 2009, when the stock market went down, T-bonds went up in price, down in yield. So did gold. So they were both alternatives. This time around, T-bonds are sick. They're anemic. They can't get off the mat. And this leaves gold and monetary metals as the only real alternative. This chart you've got here was in our weekend report and some prior reports. It shows a spread relationship, what we call relative performance relationship, between each monthly close in gold divided into the S&P 500, express that as a percent, and you plot it on this percent chart. This goes back to 2013, when gold was coming down, of course, from 2011 to 13. Well, so was its relative performance to the stock market. So therefore, you see a decline in the spread value. But then over the last 11 years, we plot a red line across each of the relative performance rally highs in gold measured against the S&P. And good grief, we have a 4-point line, almost flat. This is what you call a massive base. We hit it in April, backed off, didn't collapse this time. Unlike the prior hits up there at the red line, you went down, down, down. This time we went down for a couple of months. No, last month we closed right back below that line. You close out over that line, meaning if you get any month where you can divide the price of the near front month futures contract, presently that's the December gold, divide it into the S&P 500 cash, express it as a percent. If you get to 60%, that's a breakout. We closed last month about 58.5%, right up against that line. Now this is, everybody says, well, we haven't broken out yet against the stock market. But remember, the S&P is a heavily distorted index. In fact, 5 of the front end stocks in that index are, they're all tech, okay? NVIDIA, Microsoft, Apple, and et cetera, et cetera. And they constitute 30% of the entire 500 stocks. Whereas 5 stocks have the weighting of 30% of what's an index involving 500 stocks.
Today's market rally is extremely narrow. A few mega-cap tech companies are driving indexes higher, while most sectors lag behind. This divergence is a classic topping signal. In earlier crises, 2000 and 2008, investors could flee to U.S. Treasury bonds as yields fell and prices rose. But this time is different. Government bonds are weak, weighed down by deficits and inflation. That leaves precious metals as the only strong alternative. As stocks lose momentum, capital rotation accelerates and gold benefits. The next shock in equities could start a rush toward the asset investors' trust when optimism disappears.
Here we measure gold the same way back to 2013, but against the Dow Industrials, Dow 30, top chart. And the bottom chart is an index people seldom look at. That's the New York Composite Index, which is, huge quantity of stocks, okay, but not distorted by front-end weighted symbols. It's more evenly spread among all the symbols. And we've broken out. Because you've already broken out of the base, where you can say, okay, measured against broad stock market metrics, gold is now freshly emerged into an outperform candidate. And when you break out of some base that's 11 years wide, that's this clear, you're not just going up for a few months. The relative performance is going to smoke for a couple of years, could be. It won't just involve gold doing better than the S&P. We argue it's going to involve both gold going up and the stock market's going down, further exploding that spread. Anyway, this is a situation people need to pay attention to when they think something is over. This is just beginning.
A key warning is hiding in the data. Gold is starting to outperform the broader market. For over a decade, gold's performance relative to the S&P 500 formed a huge base, indicating quiet accumulation. Now that base is breaking upward on charts that track gold versus broad stock indices like the Dow and the NYSE Composite. This suggests a long-term shift, not a seasonal move, but potentially years of gold outperforming stocks. The spread between these assets is beginning to widen, signaling a powerful new trend. When big bases break, history says the follow-through can be extraordinary.
The spread relationship is sort of stunning. You look at the S&P, which has a beautiful structure. I mean, it'll explode when you get out of there, the gold relative to the S&P. But it's already broken out versus broad indices. And everybody knows right now that, yeah, the S&P and NASDAQ 100 are highly focused on just a few symbols. In fact, there's 5 or 6 symbols in the front end of NASDAQ 100. Remember, there's 100 symbols in it in the index. 5 or 6 symbols up front are 50% of the index. Why even call it an index? Just call it a call option on 5 stocks. But anyway, but everybody knows it's distorted, and they're scratching their head, and yet it doesn't seem to go down, so they've given up on that notion that you have a distorted situation, which is fine. Because when it breaks, then they'll be surprised. That's...
Bear markets are not brief events. The dot-com crash erased 82% from the NASDAQ 100 and took 16 years to recover. Meanwhile, gold surged. Painful downturns shake belief in traditional investments, leading people to reevaluate money itself. Today's risk is larger. The world faces not only market speculation, but a sovereign debt crisis. If governments try to print their way out again, currencies weaken further. That is when gold historically becomes a refuge. The deeper the damage to household wealth and confidence, the faster demand accelerates for assets that cannot be devalued by policy mistakes.
The bear market, you're talking the bear market in stocks now, okay.
Or a bull market in gold, both?
Yeah, no, it's going to be, I think gold will do more than the eightfold move. Meaning $8,000, when we get there, I'll simply acknowledge in our reports, we told you it probably will match at least what it did twice before, under global conditions that are hardly as catastrophic pending as the ones we have now. Okay. Stock market, when it goes down, usually goes down for 2 to 3 years. You go 29 to 32, 2000, 2002, 2007 to 9. And it'll go down between, S&P down 50%, for example, 2000, 2002. But during that same time, it wasn't excuse me, AI stocks, it was .com, internet. Okay. And all the claims about internet were true. It was going to change our life. Yet the NASDAQ 100 went down 82%. 82%. I mean, it might as well gone to zero, okay? It wiped everybody out, and it took till 2016 for the NASDAQ 100 to come back up to the nominal price high it saw in 2000. So not only did it break 82%, but if you didn't get out, and we did, by the way, say out in January 2000, it took 16 years just to get back to break even, and that's nominal, not counting the degradation in the money unit. So I don't know how far the stock market will go down, but I can say it will go down seriously enough and also create the more important issue for gold and for the global sense of uncertainty about what we've done before. will be when the pain comes from in the wake of the stock market decline. That's when you see, if you go back and look at the data points that everybody likes to talk about, unemployment and everything else that the Fed looks at. The real bad numbers didn't come until after the stock market really started down. You might have had some marginal indication there's decay, but the real pain to the average guy in the street did not occur until, let's say, 2008 and 9, for example. Unemployment, et cetera, homes lost, et cetera. This time we have a much bigger crisis because we have a government debt crisis, not just mortgages, okay? We got Japan, US, there's others. It can't be printed away this time. And if they try to, which they will, print it away, monetary excess, what's the prime beneficiary of that? It's always been gold, monetary metals. And this time we happen to think silver is the one that will outpace gold starting very soon in a way that is likely to really shock people. I think we even have a chart of that in this report at page 10, I think it was. Yeah, there you go. If you can focus in on that a bit there, I don't know if you can or not. Yeah, the top chart, forget the bottom chart for the moment. Top chart is simply a spread chart. Again, divide the price of the front month silver into the front month gold, express it as a percent. And you can see back, this goes back to 2020, 5 years, okay. And there was a low in early 2020 when the silver price was less than 1% the price of gold. And you exploded up out of that hole. That's when we had that sharp rally in gold and silver in starting in March of 2020 through late summer, later that year anyway. 6 months of explosion in price. Well, during that time, silver really gained versus gold. It was the better place to be. But since that, in fact, that spread peaked in early 2021, since then, you can see that the spread, the black line, has zigzagged down. What does it mean? It means, yeah, silver was going up all during that time. We're way higher than we were in 2020. We were $30 then. We're now, either side of 50. But it was underperforming gold. So gold's done better over the last 5 years. But during that time, you can draw a couple lines on that top chart, the spread chart, technical lines. There's the black downtrend, which you bumped a month ago, and then last month downticked ever so slightly from that line, thereby acknowledging the line as being valid, okay? And then there's the red horizontal line above you on that spread chart, top chart, just above 1.3%, meaning divide silver into gold. If it's 1.3%, you're bumping that line. Okay. Actually, 1.32%, and you break out over that base. That base goes back 3 years. So it's a wide base. Why is this spread important? If you go back into the 1979 surge in silver, with silver had already been going up for years, just like gold. So they're both in bull trends, but silver was underperforming gold, much like this chart here. But in the summer of 79, 5 months before you peaked, the spread broke out, saying, okay, yep, I've been underperforming gold the last couple of years, both going up, but silver just not going up as much. Silver said, I'm now going to perform gold. Silver went up 4.5 to 5-fold in 5 months. Went from $15 to 50, okay, in 5 months. So the bull trend went vertical, okay. The same thing happened late in the bull trend in 2010 and 11. We know the monetary metals peaked in 2011 after having been going up for a decade. But I think it was September of 2010, again, you looked at the price charts, gold and silver just trekking up, fine, everything looked good. But silver broke out on a spread chart that looked fairly similar to this one. And it said in September 2010, okay, now I'm going to beat you, gold. And silver doubled in half in 6 months in net price, okay? So that's why this spread is important, because it tells us that we're at a phase where silver, which is vastly undervalued to gold, historical measurements, going back 50 years, could zoom in relative performance and in net price. It is our argument, based on a lot of technicals we won't get into right now, but partly on the triggering of this spread, which you can see we're all about ready to break that black downtrend line. And the red line above on the spread chart that's total breakout. We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100, at least more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical when this spread breaks out. Now, if you look at the chart below, this is what we do. We look at momentum and structure. The spread chart has two breakout levels, and the momentum chart also has two, except that the momentum chart's already broken out over its downtrend. Okay, heads up, and then that peak that we made in September and downtick slightly in October on the black line on the bottom chart, we already hit that triple top structure. Downtick slightly, didn't get slammed, very downtick. You close above that red line on the momentum chart, that spread chart will follow very quickly. So we're watching momentum as a leader. It almost always leads in this situation. So we have a situation here where we think silver is about to go vertical, but that is a signal that both monetary metals are about to go vertical, with silver in the lead. So this is what we're focused on right now.
Gold often leads, but silver is the accelerator. Although silver climbed in recent years, it has mostly lagged gold. Now, technical signals show a massive reversal forming. Similar patterns in the late 1970s and 2010 triggered explosive rallies, where silver soared 4-5 picks in months. The gold-to-silver ratio is stretched to historic levels, making silver extremely undervalued. Analysts tracking momentum expect silver to not only follow gold upward but launch faster and farther, potentially doubling or tripling as confidence collapses. What begins as a gold rush often ends with silver stealing the spotlight.
Hard to explain, except that it is. In other words, usually when we see a top in a market or a bottom, I'm talking price down. By the time the price chart says, ooh, I'm broken, you might be 20% off the high of the market before it speaks anything. But you'll invariably, when you run long-term momentum and you're trying to define a bottom or a top, the momentum of the action of price will have already broken out over a structure as well. In this case, as an example, you can see that the spread, the momentum of the spread, the bottom chart, has already emerged above the downtrend, whereas the spread chart is bumping the downtrend. So if in fact we do turn up from here, which I think we are, you'll see that momentum did it first. This is also true when you simply measure price versus the momentum of price. And it's our modus operandi. What the academic basis for it is this. We don't like wet noodle momentum indicators, like the kind you get on your quote screen, RSI and MACD that look like wet noodles. Okay. They don't provide structure. They just sort of say, oh, I'm at a high level, okay, which often is distorted anyway. The notion of what's too high or too low can change. But when you create momentum of price, what you've done is you've backed out of simple measurement of an asset measured versus a money unit. The price chart is nothing but silver ounce versus the US dollar, for example. Well, heck, the US dollar is degrading constantly. I don't mean versus other currencies. I'm talking about in and of its real buying power, because the quantity of dollars goes up like 90% every decade. Okay, so like when your granddad built a house, it cost $4,500. When your father built the house, it was $45,000. Right now, the median home price is $450,000. That expresses the ongoing decay in the real value of the thing in your wallet, okay? To factor that out, that means you've got a yardstick that's plastic. So when you measure something year to year over a 10-year period, there's been a distortion in your yardstick that is messing up your view of the technical action. When you run a momentum of it, you haven't fully moved the money unit out of the equation, but you've at least injected the dynamics of the asset itself, its momentum, strong or weak, whatever it may be, into part of the overall measurement. So to some extent, you've stepped away from simply using a money unit as your yardstick, okay? And that sort of cleans it up a bit, if you know what I mean. and it often gives you a structural picture that is different than when you see on the price chart.
Market transformations feel slow until suddenly they are not. Momentum indicators reveal that metals are preparing a vertical move, even before price fully reflects it. People assume stocks will always recover, but when pain becomes widespread, job losses, credit tightening, shrinking portfolios, behavior changes fast. Investors seek certainty, not promises. Gold and silver offer that certainty. As liquidity drains from stocks and government debt loses trust, monetary metals may enter their most powerful phase in decades. The shift isn't coming someday. The groundwork is already in place. The smart money is moving early.